This tutorial was developed purely with educational intentions and in no way should be considered as marketing, nor deemed a recommendation to buy or sell any securities. It should not be relied upon for the purpose of making or communicating investment or other decisions. Many people find financial matters complex and difficult to understand, but this needn't be the case. At its most basic level, the financial world is a set of practical rules that have been invented over time to help people buy and sell goods. It's a bit like the rules of the road. Once you know them, driving is much easier. In this video, we will give you an overview of financial principles to give you a basic understanding of notions and terminology. It will not enable you to be a professional investor, for that you will still require years of experience and practical knowledge, but it should help you have meaningful conversations with your financial advisors. Understanding the basic rules of finance is not something for just an exclusive group of people, nor is knowing how financial markets operate. Importantly, these characteristics on their own do not make a good wealth manager. The key to that is experience. Financial markets run at a fast pace and experience numerous ups and downs which cannot be put in a textbook. Rather than spending money, finance is mostly about investing it into companies. So, understanding their accounts or financial statements is key, and that is where we shall start. Every business has to keep track of its financial position, which they do through a balance sheet. This reports a company's assets, liabilities, and shareholders' equity at a specific point in time, usually year-end. In simple terms, a company's total assets, shown on the left, are what the company owns. Cash in the bank, inventories in the warehouse, buildings and equipment, and its brand. Meanwhile, the column on the right shows sources of money used to buy assets. The first type is liabilities or borrowings. This can be loans from banks, debts to investors if the company has sold bonds, or payments due to suppliers. Second source is capital. This can take the form of equity from owners or third-party shareholders, or from profits it has made, which are known as retained earnings. This is where we see the bonds and shares that are traded on the open market. They are either loans, bonds, or equity, which makes up the market value or capitalization, shares and equities. It's called a balance sheet because everything has to balance out. The left side, a company's assets, must be equal to the right side, its liabilities plus shareholder equity. We will look at traded bonds and equities in more detail shortly, but for those interested in accounting, stay here. We will wrap this section up first. The next thing to understand is a company's profit and loss. Along with balance sheets, companies also keep track of their profit and loss and report it regularly. In practice, profit and loss is a straightforward document. It lists the revenue a company has earned, also called top line, and subtracts all of its variable expenses and fixed costs to arrive at a final figure, net profit. However, there is usually more detail available. So, a quick walkthrough. Revenue, i.e. goods you sold times their price, also called top line. Less all expenses related to production of the goods, costs of goods sold, COGS, or variable expenses. Less all fixed costs, for example, office, marketing, IT, personnel, etc. Equals operating income or EBITDA, earnings before interest, tax, depreciation, and amortization. This is a very common metric in finance because it basically shows the operational profit of the business. Less interest you paid on any loans taken, less corporate tax, equals net income or net profit for the year. Net profit can be distributed as dividends. Otherwise, it is included in a company's retained earnings on its balance sheet. Our final point on company accounts is cash flow. To know how much a business is worth, a cash flow statement is a good starting point, as it helps investors determine if the price they are paying for shares or bonds is fair. Cash flow statements show three types of cash a company generates: from its main business operations, that it spends on buildings or machinery, called CapEx, or otherwise invests in the business. Occasionally, this will also include profit or loss made in financial markets. From financing activities, such as interest received or paid on loans or dividends paid out. Together, they show a company's free cash flow, the total amount of cash a business generates during a given period, usually a year. The cash balance on the company's balance sheet at the end of the financial year will equal cash at the beginning of the year plus free cash flow during the year. Although they can be, in themselves, a complex task to put together, even for small companies, these three documents broadly form accounting and are the basic tools you need to assess the health and valuation of a company. Now we have looked at how companies keep track of their finances, let's shift to investments. A bond is a form of debt used by companies and governments. Rather than take a loan from a bank, companies often borrow from investors by issuing bonds. A bond has two key elements. First, when a company sells a bond, i.e. borrows money, it tells its investors when it will repay the loan. This is known as the maturity date. Second, it tells investors how much interest it will pay for borrowing the money. This is known as the coupon. When governments and companies issue bonds, they are often priced at 100%. Meaning, if you lend or invest £100,000, you will get the same value in bonds, which is known as the nominal. Bonds can be bought and sold on financial markets, which means their price can go up and down. The price you buy at impacts the return you make on the investment. The cheaper you buy, the higher the return. The return on bonds is also called yield. The yield is calculated based on the price of the bond, its maturity, and the coupon. If you buy at 100, your yield is equal to the coupon. However, if you buy a bond below 100, any difference is your extra profit, divided by the number of years remaining till maturity. For example, if the bond's price at issue was 100, it has a 5-year maturity, and its coupon is 6%, then the yield is also 6%. However, if an investor buys that same bond on the market after its price has fallen to 90, its yield will go up to 8%. 10% over 5 years equals an extra 2% per year. On the other hand, if you buy at 110, your yield will go down by 2 percentage points to 4% per year. It's important to remember that the bond's yield moves in the opposite direction to its price. A higher price pushes the yield down, while a lower price pushes it up. However, the scenarios above assume that the company, or government, both pays interest and returns the principal at maturity as it promised at the outset. Failure to do either is known as default. The more likely it is that a company might not pay back investors, or default, the higher the risk, and therefore the coupon, or compensation for this risk, is likely to be. The risk of a company defaulting is the investor's job to assess. But there are also special credit rating agencies that do it. They analyze a company's financial situation, strategy, and other factors, and issue credit ratings on a scale from AAA to D. The higher the rating, the more secure the issuer is assessed to be. The safest asset is considered the government bonds of the largest global economy, the USA, called US Treasuries. Their yield is close to the government interest rates and broadly to the rate you can get on a deposit in US dollars. Other corporate or government bonds are compared to the yields Treasuries offer. The bigger the difference between the bond's yield and that earned from US Treasuries, the higher the risk. When government interest rates go up, they push all yields up and prices down. So, bond prices are affected by the company's financial situation, its ability to repay debt, and external factors like government interest rates. On financial markets, company shares are often known as equities. To be able to sell equities to investors, a company conducts an initial public offering, IPO. Through this process, it lists its equities on a public stock exchange so investors can easily buy and sell them. These equities deliver returns to investors in two ways. The first is by their price going up, the other is by paying a dividend. As we mentioned earlier, when companies pay dividends to investors, it comes from annual profits and is often expressed as a dividend yield. This appears as a percentage and financial ratio showing how much a company pays out in dividends each year relative to its share price. Not all companies pay dividends. It's up to the board of directors to decide. Some companies don't pay dividends because they are not profitable enough or they are making a loss each year. Some companies don't pay dividends because they would rather reinvest their profits into the business. For example, high-growth technology companies tend not to pay dividends, as they prefer to invest into their expansion. Many companies that do pay dividends to shareholders are large, mature businesses that are not expanding rapidly, meaning that their share price is less likely to grow quickly. Utility companies and industrial businesses are among those that pay higher dividends because they are not experiencing high growth. However, they generate substantial cash flow that can be returned to investors. Some companies offer occasional share buybacks to compensate investors instead of paying cash dividends. This sees the company buy its own shares from the market, thus increasing its share price. The effect is the same as paying dividends. To determine if a company's share price is an accurate reflection of its value, investors use two main methods. The first is discounted cash flows. This bases an estimation of what a company is worth today by how much revenue it can generate in future. The idea here is that businesses are theoretically worth the present value of all of their future cash flows. The first thing to do is calculate free cash flow, which is in the company's cash flow statement, and forecast it 5 to 7 years into the future. To do that, you need to have a good understanding of the business and make reasonable assumptions around its revenues and costs during that time. Then you need to define your discount rate, called WACC, Weighted Average Cost of Capital. In essence, this is a rate of return you should expect from a similar business. It can be broken down into weighted average cost of debt, or at what interest rate the company will be able to borrow, and cost of equity, or how much its shareholders can reasonably expect to earn in a similar business, country, or industry. The sum of discounted cash flows will give you the value of the company including debt, called enterprise value. If you deduct debt, the result will be equal to its market capitalization, usually shortened to market cap. You discount your free cash flows by this WACC, and to get present value of cash flows, which is the estimated value of the company until the last year of forecast. After that, you assume that the business will grow at a modest rate, called terminal growth rate, G, and calculate remaining value using the formula FCF in year 5 times by 1 plus G divided by WACC minus G. Present value plus terminal value gives you the enterprise value of the company. Note, it values business as a whole, including debt, on the right part of the balance sheet. So to calculate a company's market cap, we need to deduct debt from enterprise value. Dividing a company's market cap by the number of shares it has issued produces an estimated share price. You can compare it with the market price to see if it is undervalued, for example, a good buy, or overvalued, time to sell. Another method is to look at commonly used ratios, such as the price-to-earnings ratio, which is market cap divided by net income, EV to EBITDA ratio, or EV to sales ratio. These ratios generally show how many years of a company's earnings it is worth. For example, the price-to-earnings ratio simply shows the market cap divided by net income. If a company has a PE ratio of 20, its value is 20 years of its net income. To see this in practice, take a few comparable companies, check what average ratios they have, and apply these ratios to your company's numbers. Let's say industry average PE is 17 times, and your company generates $36 million of income. That means its market cap can be estimated at $610 million. Each of the methods discussed here are different ways for investors and analysts to try and find a company's fair value. They rely on the available information being accurate, making forecasting possible. This means they are not always useful for startup companies or venture capital investments, which don't yet generate any cash flow. We have covered the fundamental characteristics of financial markets. So our final topic is where people buy and sell company shares, bonds, and other investments. Stock markets operate on the principle of supply and demand. A scarce product will cost more, because there are more buyers bidding for it than those willing to sell, and vice versa. However, in practice, there are multiple additional factors that influence the price of shares and bonds, although they are all interrelated. Major economic, political, and environmental events around the world all affect financial markets. Each investor tries to predict whether the price of a company's share or bond will go up or down, and thus what investment decision they should make. The market only functions because for every asset, there is a buyer who thinks something is cheap and a seller who thinks it's expensive. In addition to shares and bonds, there are many other instruments that trade on financial markets. These include currencies, commodities like oil, metals, and grain, as well as derivatives of these assets, such as options and futures. The theory around supply and demand works for them too. We hope you enjoyed this tutorial on the financial world. As you can see, the theories around equities, bonds, valuations, and markets are not complex. But it takes practice, experience, detailed analysis, and knowledge to put them into practice in the real world successfully.